The retail crowd's not buying a lot of gold and silver right now relative to other times like 2008 to 2011, 2012. But there is enough buying from other parts of the economy and other players that gold and silver has been drained a lot. So when that retail comes back in the next recession, it's going to drain the remaining stocks pretty quickly. At that point, it'll be blatantly obvious to everybody on the markets that the prices need to rise. And then you're going to get, I think, that last big bull leg in gold and silver before the blow off top, which will probably last a couple of 3 years if history is any indication. I think in 2024, we're headed into that. That's why I've been talking about 2024 being that year of the battle against the longs and the shorts.
As 2023 dawned, economists and financial experts held a strong conviction that the United States was on the brink of a recession, supported by Bloomberg's probability model, boldly stating a 100% chance of recession within 1 year of October 2022. However, RobertKientz, the editor and publisher of GoldSilverPros.com, offers a unique perspective, suggesting that the global economy might have silently slipped into a recession long before any official declaration. Kientz believes that the mere acknowledgment of a recession could trigger a substantial shift towards gold and silver, signaling a potential turning point in the financial landscape. Reflecting on past recessions and the 2001 economic downturn, silver prices fluctuated around $3 per ounce, while gold experienced a gain of about 7.3%. This contrast stood into the 2008 and 2009 recession, when gold prices surged amid concerns about hyperinflation triggered by extensive money printing by central banks. In contrast, silver prices remained relatively stable during that period. Kientz identifies 2024 as a pivotal year, foreseeing a potential upswing in gold and silver prices. This anticipation is grounded in deteriorating economic conditions and the depletion of precious metal stocks. InvestingHaven.com echoes this sentiment. The price of silver will move to our first bullish target in 2024, which is $34.70. We predict $48 to be hit either by mid-2024 or mid-2025. JP Morgan Research offers a corresponding projection for gold prices, estimating a peak at $2,300 per ounce in 2025. This forecast is contingent on the assumption of a Fed cutting cycle, initially delivering 125 basis points of cuts over the second half of 2024, propelling gold prices to new nominal highs. Kientz suggests that the bond market could serve as a leading indicator, revealing stress before the stock market reacts. The anticipated collapse of the bond market is attributed to excessive debt that becomes untenable to repay at higher interest rates. Earlier in the year, there was a notable sell-off in debt markets when central banks increased interest rates to combat inflation. However, the situation took an unexpected turn as bond prices surged following the collapse of Silicon Valley Bank, prompting a flight to safety. Join us as we delve into insights shared by RobertKientz. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Probably been in a recession for quite a while. The government just isn't calling it. But once we get that official call and it's blatantly obvious to everybody, people are going to rush into gold and silver. So tying that into gold and silver markets, that stock's not going to last forever. If you get Joe and Sally down the street investing a little bit of silver and gold, very quickly that demand will overwhelm our stocks. The stocks which have slowly been depleted the last few years by industrial demand and demand from central banks for gold and in demand for heavy investors in both gold and silver. The retail crowd, in other words, to summarize this for you, the retail crowd's not buying a lot of gold and silver right now relative to other times like 2008 to 2011, 2012. But there is enough buying from other parts of the economy and other players that gold and silver has been drained a lot. So when that retail comes back in the next recession, it's going to drain the remaining stocks pretty quickly. At that point, it'll be blatantly obvious to everybody on the markets that the prices need to rise. And then you're going to get, I think, that last big bull leg in gold and silver before the blow off top, which will probably last a couple of 3 years if history is any indication. I think in 2024, we're headed into that. That's why I've been talking about 2024 being that year of the battle against the longs and the shorts, because the economic data is weakening. Some of these asset classes really aren't supported by that economic data. Consumers are out of money. Eventually, these have to start falling. We've started seeing it again with the corporates and the earnings reports the last 2 quarters, but this quarter especially, the earnings reports aren't supporting all-time high stock prices. The thing that was supporting it was the corporates cutting jobs and cutting costs. Well, now they're not going to be able to cut much more. Yes, AI is playing into that, but at some point you still have to have employees. And with all those people cut, what's going to happen is consumers were on credit. Remember last month, the last 2 months, we said they're on buy now, pay later, and they had the highest revolving credit ever. The ones that are getting laid off are living on credit. And so there's not going to be as much purchasing. That's going to collapse. So the consumer is going to collapse. The corporates eventually will start headed back south. The stock market will start to come down. All of this comes after the weakening of the fundamentals. The weakening of the fundamentals comes first, then people run out of savings, then they live on credit, then the corporates cut, which they've done, which exacerbates the consumer who no longer has any more savings, and then they run out of credit, and not enough people are employed full-time with benefits, and so the economy starts to retract, and then you get into the big, deep contraction. So I think the last couple of years we've been living in this slow decline of the consumer, but now the consumer is about to go like that. And that's what the leading economic indicators told us, which is why I put it out on the program. So adding it all up, we're sort of in the calm before the storm. We're in the eye of the storm. We had issues in 2008. We had some issues in 2020. Now we're sitting in the eye of this hurricane, okay? And what's going to happen is when we get to the other side of the eye, as the hurricane moves through and the fundamentals, the technicals are going to start indicating it. People are going to rotate out of these other asset classes into gold and silver. There's going to be a run because the gold and silver stocks have been depleted through industrial demand and central bank demand and big player demand. The small guy's going to get in and not have enough gold and silver. It's going to shoot those prices back up. Then we get that last leg. And yes, this has taken some time, and I understand some people get frustrated with the prices, but nothing happens overnight in these big global markets. It takes time, but we're really getting close. You can see it in the data. The economic contraction is coming. The consumer's been tapped out. They're living on credit. That's going to crash. And then at some point in time, the economy's got to go with it. The corporates are going to go with it when they can no longer cut anymore without eating into their own products development. There's not going to be that demand. And then you're going to see the stock crash, and then the bonds will spike up again. The bonds are already up. You already have the yield curve inversion because bonds are smarter than stocks. Bonds will show pressure before stocks do, but then the bonds will start to collapse too because why? So much debt that can't be paid back at higher interest rates, and it's going to collapse that market.
Concerns have been on the rise, driven by multiple geopolitical factors such as the war in Ukraine, the Israel-Gaza conflict, tensions in the Red Sea, escalating inflation, and the increasing burden of servicing debt. The collective impact of these elements has raised the specter of a potential global recession. Kientz draws parallels between the current economic landscape and historical periods marked by significant challenges, citing examples such as the 2000 tech crash and the 2008 financial crisis. In the present scenario, the Federal Reserve finds itself in a delicate position, balancing its aspiration to achieve 2% inflation against the risk that delaying rate cuts might inadvertently usher in a recession. Anticipating challenges associated with higher interest rates, especially when various debts, including those from the Bank Term Funding Program, come due, Kientz underscores the potential complexities. The economic resilience observed thus far has granted the Federal Reserve some additional leeway to maintain higher interest rates while monitoring the gradual but consistent decline in inflation data. Let's get back to the interview.
There's no way to make up for a dead consumer who doesn't have any money. There's no way that corporates can cut past a certain point to the point that they don't cannibalize their own production and their own efficiency. There's no way to taper over or to paper over higher rates on bonds when those come due. And when all these bonds come due, when the Bank Term Funding Program comes due and everybody's got to pay back this debt at higher interest rates, that's when you're going to see that collapse. And I think all of that is starting to occur now. You can see it in the data, and give it a little bit more time, and eventually you're going to hit that waterfall. And that's what everybody's looking for in terms of the obvious. It's not obvious yet to people. We're a little bit of a euphoria stage with the stock market, but that will change. It'll change very quickly. All you have to do is look at 1929, 2007, 2008, 2000 tech crash, 1999, 2000. We all partied like it was 1999, and then we paid the price in 2000. We partied like it was 1999, and we paid the price in 2008 through 2010. We're partying like it's 1999, but we paid the price during 2020 with the shutdowns. We partied like it's 1999, but we're paying the price right now with what's going to be probably the biggest recession in American history coming up in the next few years, more than likely, looking at the data. And I think that does start in 2024. That's why 2024 has been key in sort of my analysis and what's going to happen. You're going to have that choppiness. You're going to have prices move up and down as the longs and shorts fight each other. But once there's no longer the support for the economy, fundamentally, the shorts are going to win, prices are going to come down, and you're going to see that boom in gold and silver. I think that's where we are. And so that's why I do this weekly market wrap up every week, because I go over the data, 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 I go over the data. This is your splash of cold water. No matter what the media is saying, no matter what these stock and bond indices are doing, you come here to get the data, which is telling you what's going to happen in the future. Because the one thing you can't do is you can't print your way to prosperity. You can't do it. It's never worked. You cannot print fiat money to prosperity. Commodity money has always been the safe haven, and the fundamentals do matter. And that's where we're getting to in this part of the economic cycle. The crash is coming. I fully believe it. And that's why I do the data for you.
Gold is in a challenging phase, confined within a trading range of approximately $2,000 to $2,040 per ounce. This indicates a period of uncertainty and consolidation for the precious metal. Meanwhile, silver experienced a temporary decline, dropping below $22 per ounce. On Monday, it hit a multi-week low. However, it recovered, trading around 1.1% higher in the session. How does the recent performance of gold and silver align with or deviate from predictions and expectations, and what implications might this have for investors moving forward? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.